Hello everyone and welcome to The Upside. I'm Kyle Cheropita. Today we're counting down the top FidelityConnects highlights from November. Connects is first presented as a live webcast for financial professionals and then released on replay for all as a video podcast, with new episodes dropping daily. So let's take a look at the month's big stories. We'll kick it off today with portfolio manager Dave Way, who recently celebrated the 5-year anniversary of his long-short alternative fund. Here with host Pamela Ritchie, he shares how the fund came to be and the strategy behind now shorting the companies that were previously just avoided.
I started at Fidelity like almost 20 years ago. It was the summer of 2007. And so over my career as an analyst, it was my job to do what all of our analysts do, which is identify the companies that are going to outperform and make sure they end up in our portfolios, and also identify the companies that are unlikely to outperform and avoid them. And one of the things that emerged from my analyst tenure was kind of a special interest in separating those companies that we should avoid and actually grouping them into, what are just sort of middling average stocks, like not terrible, but not as good as the winners that we can find. And then finding the companies where real problems were about to emerge and where you would see more material underperformance. And fast forward to 2018 and talking with Andrew Marchese, our CIO, about opportunities to try to use that skill and sort of demonstrated success that I had over my analyst tenure, and really coming together with a long-short alternative fund where we could do what we do on the long side, get excited about opportunities, find the winners and capitalize on those, but also, both enhance returns and reduce risk by taking advantage of that pool of underperformance and using shorting as a mechanism to find additional uncorrelated or less correlated sources of returns. And so that really came into the fund's objective of saying, hey, there's an opportunity to take advantage of what we do to have a different return stream and lower risk. And when I started the fund, that was my objective. And I'm kind of sitting here 5 years later, hoping to continue to kind of do the same.
Well, it's incredible. And there have been some stark moments where you've been able to sort of hold onto the handlebars and ride up and down some of these jagged market moves that have happened over the course of the lifetime of this fund. Are we in another one of those moments right now?
I think the only constant in the market is change. And
okay. It's a good answer.
If you look at a market chart over 100 years, it kind of looks like a pretty smooth ride. And the reality is there's volatility. And it's really important that when the market is rising, to capitalize on that, to capture returns. But I would also say that it's equally or even more important to protect capital during the periods where we do see that downside volatility. And when it happens, it can be big. And it's important to stick to a long-term process, protect capital, and be ready for the other side.
But you don't want to be too early calling a market downturn. That's sort of where we're sitting right now. And I want to go back into history to sort of get us here. But we are apparently grappling with whether it's too early to call a market top, aren't we?
Yeah, I think in some ways it's a fool's errand to sort of say this is the top, this is the bottom. And the market is a big place with lots of different things going on, different sectors, with different types of cycles going on. And so before we launched the fund publicly, I was running a pilot version of the fund.
This is in COVID?
It was 2018 through 2020.
Okay.
And as we got to the end of 2019, one of the things that I started to see emerge was some overheating in parts of the consumer environment, some overheating in the financial sector where credit risk was growing. And so I didn't know that COVID would be the catalyst for those shorts playing out. But ultimately, when things are just like really good, sometimes bad things happen. And so what I try to do is look at the market on a bottom-up basis. The top-down tells me what's the weather? What should I wear outside? But you go outside and you look for ideas and try to do bottom-up stock picking and look for stocks that might be priced for perfection, where there's things that could go wrong. And then you try to execute on the short portfolio, while at the same time being open to the fact that, whether, valuations are at concerning levels at a market level, or if, things seem too good, that there will always be idiosyncratic opportunities to find companies where things are getting better.
AI is here to stay, both as an investable theme and as a common addition to our daily lives. Early in November, we held an extended webcast focusing on AI, featuring portfolio managers and special guests. Replays can be found as a FidelityConnects podcast on YouTube and Spotify. Here's an excerpt from Mark Schmel and Annie Wang's segment discussing the potential of an AI bubble, use cases, and what they see firsthand being based in San Francisco.
Let's clear some stuff up. There's a lot of talk today about an AI bubble.
Yeah.
Now, Bill Gates would say that we are in a bubble, so would Michael Burry, and then Jay Powell would say, we're not. Can we start there before we get into the whole theme of AI?
Sure. It's very topical. The market is wrestling with that as we speak. I think that the easiest way for me to address that is there are two camps. There is a very bullish engineering camp who sees the application and they're so excited to be working on it. And they're saying, look at all the things I can do with AI that I could never do before. Oh my goodness, I'm so excited. And then there's the finance camp, which is very skeptical and saying this has gone too far too fast. And I don't think you engineers know what you're talking about. And it's clearly a bubble because my experience tells me it's a bubble. And so I think that what you have to answer for yourself as an investor is, who do I want to believe? The finance geeks in Wall Street or the engineering geeks in Silicon Valley? And for me, the engineers are seeing this more clearly than the finance guys are. They see the applications, they're in it, they're doing it. I'm going to go with the engineers on this one. So my view is, it does seem a little overheated, but I do not believe it's a bubble as we speak now.
And if we think of the chart room, which you're a user of, there's always little retracements within the market.
Always.
But overall, the theme is there, it's powerful. Maybe some things are overheated, whatever, but that's what portfolio management's all about.
Nothing has changed. Fundamentals haven't changed. If anything, they're getting better. So I don't know.
And Annie, this is what the analyst side is all about as well. As director of private equities, talk to us about the importance of the private space within this realm.
Sure, absolutely. This is where a lot of innovation is happening. We're talking to the engineers and understanding where the big ideas are. And so it's really my job and my team's job to be on the ground, meeting founders, talking to people that are building in the space, and almost trying to serve as a bridge between that community with the portfolio managers and people who spend most of the time in the public markets to understand what could happen in the future.
And you're based in San Francisco.
I am.
What size team are you part of?
Yeah, so our team is actually quite small. The private equity team is about 10 people. But we're very fortunate in that we're able to work with portfolio managers like Mark and lots of peers on the public side who are constantly thinking about AI as well to collaborate together.
And then, of course, you have the whole universe of Fidelity to be working with and drawing on and contributing to as well,
Yes.
not just in San Francisco with your key team.
Absolutely.
And Mark, how do you work with the private equity team?
I talk to them every day. Annie sits right across from me. The rest of her team is dispersed around the world. We have Vishal in San Francisco as well. I think that they have just the greatest window on the future, and they see what's happening before everyone else does. The themes, the smartest people are in the private world. They're working on things we never even heard of before. And so it's just a lens on what's coming at us. And in the public markets, you're always dealing with, well, the future. In the private markets, you're living in the future, so to speak. And so from that standpoint, it's a great information source. It's really great to talk to these innovative founders. Annie will come to me every day and go, have you heard of this company? She does this, what was the name of the company today? I can't even remember. I was like, have you ever heard of this company? No. Do you know anyone who uses it? No. So like, this is the kind of back and forth we have all the time. And then we try and figure out, does anyone like this company? Do they use it? It is incredibly valuable. And being based in San Francisco is a huge, huge edge for like all things private.
So Annie, you're discovering things every day.
Yeah, absolutely.
Now, what are use cases of AI in your view? From what you do, but also what our clients can take away?
Sure, absolutely. I mean, I think there's a few that really come up, in terms of on the consumer side. I think ChatGPT as a personal assistant, and people just use it for so many different things, from finding Christmas gifts, right, to like improving my writing. And so I think in the consumer side, you've really seen a lot of traction there. On the enterprise side, coding is something that has emerged as a killer use case this year. Also see a lot of traction with customer success, and there's just a lot of startups that are building the space to build more specialized agents for like certain domains. I think it's still early, but definitely a lot of smart people working in the space.
Early is a key point because there's a lot still to be learned, and the way that it's learned is by trial and error, isn't it? When EVs came out, autonomous driving, there was a lot of trial and error. We won't get into that, but that's true with AI in general, isn't it? There's a lot that needs to be out there in the world for the companies to learn more from. So
Yes,
a lot's still to go.
Yes, definitely.
It's in its infancy.
Yes.
And why don't we go to the journey of a private company as well? As far as the development of a private company to then public, is that something that you want to talk to our customers about?
Sure, absolutely. Like I think the way we think about it is we want to meet the big, important public companies of tomorrow as soon as we can, and invest as soon as we can gain conviction that they'll be an important company.
Great, thank you. Mark, how do we coexist with superintelligence?
Good question.
Just a brief answer is fine.
I don't know that we're going to see super intelligence.
Yeah.
I'm just going to be happy with a better tool, generally speaking, and I think that that's how I think about AI. It's a better tool for a lot of different use cases. And as Annie was saying, we don't really know where they are. Like they're planting seeds everywhere, right? They're taking their super intelligence and throwing it at all these different problems. And there's other ones that I can't even remember all the names anymore that are attacking coding, and we just don't know where it's going to really work. But I think the one way to think about AI is this is the worst it's ever going to be. Like it's just going to keep getting better, and we know from having watched it over the last 3 or 4 years that the capabilities of ChatGPT or Anthropic, it's amazingly different over 2 years. And then as we throw more compute at it and the algorithms get better, it just feels as though this is going to continue to get better. I don't know that we get to super intelligence, but what about super tool? Like it's going to be a super tool, and it's going to allow us to do a lot of things.
That's less ominous if it's, I think, thought of as a super tool versus super intelligence, because we want to work alongside. Do you see the day where you have a robot walking around in your house washing your dishes?
Yes. We are currently looking at robotic companies in the Bay Area. It's funny, they're all working on folding. It's like really funny. There's like 10 different companies that are all working on folding clothes with the arms of the robot. I think that the robotics is not a hardware problem. I think it's a software problem. So the brain of the robot has to be good enough. And so what we need is we need the intelligence to get there. And you can sort of see the runway to getting there. I don't think it's outrageous to think that we may have robots in our homes in the next 10 years or 15, depending on supply chain and whatnot. You can see what they're doing, and you can sort of see the path. It's sort of like it took, I don't know how long it took Waymo to get going. 15 years from beginning to where it is now. Maybe 15 years for robotics, maybe not. I don't know, but you can see the path there.
November was Financial Literacy Month. Host Emily Ananuevo caught up with Rob Carrick, who has recently retired from his longtime position at the Globe and Mail. Here, Rob teases some of his investing lessons from his career and shares his advice for how to invest in present day's challenges.
You said in your article here, quote, the formula for success in personal finance: spend less than you make, keep debt manageable, and save and invest regularly. I'm just curious, Rob, are Canadians set up in these economic times to do just that?
You know what? I think that they are set up to do it if they are able to find a path through a lot of the challenges that are out there. And there are more challenges than we've seen in quite a while. There's the trade war, there's the global uncertainty, there's high inflation and high living costs. It's tough out there. I think it's doable, but I think people are going to have to work a little extra hard. And I hate to say that. I hate to put the onus on people and say you have to do better and find different ways, but there's no way around it. I think that, you know, the paths to success are what they always have been, but you're going to have to find a way to find that money to invest, to save, to put away for the future. I know people feel like it isn't out there, but I think we need to sort of find a way to point it out to people that they do have this capability.
So lots of economic challenges and barriers facing us today. But like you said, a lot of the onus is on the person to save, invest regularly. You also point out in the article, it's never been harder to be good with money than it is today. Is that really the case?
I think it is because there are so many prompts to spend right now. I mean, people understand the need to save and invest, but the key to it is having money left over after you get paid. And if you've met all your expenses and bills, etc. And, with social media out there documenting the great lives everybody's leading. I think it makes people feel like I have to live up to that. I have this fear of missing out. I have this fear of not looking as good as my friends. And then there's this whole other movement that I'm reading about lately about how you manifest your best self through spending. I think we are sort of talking ourselves into this necessity to spend. And I think we have to fight against that to some extent.
And you talk about social media in your article too, and just this, you said this image to keep up with spending and also rewarding yourself when you accomplish something or when something happens. It's spending it regularly and keeping up with that image. It's hard for the younger generation to keep up with, would you say?
It's really hard. And first of all, they're like lab experiments. So we don't, like the boomers and Gen Xers and even millennials, the older millennials to some extent, never had to live with that. This idea that I'm living my life and I see in real time the lives my friends and family members are leading, and I'm constantly comparing myself. And it is brutally tough. And I think we need to sort of empower people to say, you know what, I need to look after my future self as well as my present self. But that narrative is hard, especially when rents are so high and mortgage payments are so high. It's hard to find money left over after you've done all your spending.
Okay, talking about empowering young people, Rob, the month of November is dedicated to Financial Literacy Month. Every year in Canada, the theme this year is talking money, opening up conversations around money and not making it taboo. You say that we should try to get rid of that whole idea of taboo. Why is that?
Well, I think that we've moved past money being taboo. I think we're able to have conversations about it now, but it is tricky because there's always comparisons being made and feelings of shame and inadequacy when we talk money with people who seem to be doing better than we are. I mean, people tend to put their best faces forward when they're talking about their investments, and I've done really well with my investments. Oh, I don't have very much debt. We're really making headway paying down our mortgage. I mean, I think people exaggerate and they sort of put a shine on how things are. And when we have these conversations, sometimes we feel like we're not doing as well. But I think we need to have these conversations. I think people are talking more and more about money. We're feeling our way along. The way I propose to do it is to say, I'm having this situation in my own money life, and I'm thinking about this question. How are you handling it? Ask questions and generate discussions. I think that's the way to sort of find some common ground and to tap into the expertise that other people have had and the mistakes that they've made, and in a way that we can all learn from it in sort of a cooperative way.
So if you're a long-term fan of The Upside, you may have watched a show back in July with Neil Constable about Fidelity's quantitative research and investments team. In November, we welcomed Gil Haddad to Connects, who is head of advanced strategies and research with QRI under Neil. Gil shares the advantage of the quant team, what they bring to Fidelity, how they access proprietary research, and help inform the company's investing decisions. Enjoy.
You've intrigued me, you've intrigued our viewers, because you just said you have access to data that others don't have.
Yeah.
Now, it's nothing that we shouldn't have.
Exactly.
But you have the ability to get.
Yeah.
We better talk about that.
Yeah. So let's talk about three sources of information: analyst data, portfolio manager data, and alternative data. The first two are proprietary. They exist only within the four walls of Fidelity. The third one is differentiated, and we'll talk why. So analyst, the company has done this amazing job at collecting the data throughout the life cycle of the idea generation. So if you're an analyst, you go meet with the company CEO or CFO. We know who you met with, when you met with them, and the note that you write after the meeting.
Do they document that and they lock it in the system? Okay.
It's one system for everybody, and it's the same format. Then you go update your financial model in the company. It's captured, the EPS estimate or the forecast and the KPIs, all of them are captured, piped into the database. Then you go write the note on the security. It has a rating from a strong buy to a strong sell. It has a price target. It has a flag about if it's a disruptor or not, and then a variety of other flags. And it has the long-term thesis on the security, and it has your updated views on what you've learned from your research on the security. Mm-hmm. All of it is captured. Then you go update your paper portfolio. We capture that information. And the best part, that information is captured for more than 20 years. And then if you ask me why, it's because data is in the firm's DNA. And then it's just an incredible data asset. So the first thing you look, is the data efficacious? And the answer is absolutely yes. It's being used by our amazing portfolio managers for years and years and years, and they use it to generate alpha. Now imagine what you can do by testing ideas going back for 20 years and measure the efficacy year in and year out. So that's the first data set.
Okay.
The second data set is the PM data. We have more than 50 portfolio managers, different stylistic ways of trading, and then they have low turnover and long tenure. It allows us to create the wisdom of the crowd. So on any given day, we can answer the question, what are Fidelity's best ideas in terms of large cap growth ideas? And then very easy to answer. It allows you to source the ideas from the best portfolio managers out there, put them in a signal. The third one is the alternative data. Alternative data, as we said, it's non-market data. So think about it, credit card, email receipt, satellite imagery, geolocation. These are data sets that are available on the open market. Now, what it takes is the ability to spend a lot of money to acquire these data sets and having teams dedicated for them to ingest, process, and create insights. So it's a substantial investment. Over the last 5 years, we've increased our spend significantly there. We've increased our resources because the firm believes in the value proposition of data in general.
And that type of data is cell phone usage, aggregated, of course, not someone's individual, I hope, but credit card usage and so on. And you can derive a lot of information from that at a particular vendor or geolocation, I guess it's called.
Exactly. So we cannot use any PII or MNPI. So all of these data sets you can
What does MNPI mean?
Material non-public information.
I should have known that.
Or personally identifiable information for PII. We cannot use that in general. So there's very strict controls and processes around it. But you can answer some very interesting questions. So we talk about, if you have, right now we're in the season of, in the fall season, and then a number of vendors have these promotions about pumpkin spice latte on Tim Hortons. If you would like to answer the question about how many, what's the sales from pumpkin spice lattes at Tim Hortons in a specific location, that's a question you can answer. Well, how would you do that? You can geofence a particular store. You have the data for cell phones going into the store. And then, of course, you're not tied to individuals, but they're anonymized. And then you have email receipts telling you about who's buying and what they're buying, and then their credit card purchases. And you can measure that before the season of pumpkin spice lattes, and there's ways for you to get that. But it allows you to answer questions that are very, very granular and detailed, and allows you to get an information edge. And then that's tremendous. So that's the alt data, the component that we spent significant resources. So we have these 3 data sources, and they allow us to create these signals. And the signal is really a fundamental thesis that you can test with data. That's all it is. And then you put it in the portfolio.
So Gail actually sat down for a French webcast as well. So if you're interested in that show, please look up Dialogue Fidelity, FidelityConnects' French companion podcast. And that interview with Neil I mentioned earlier can also be found as an Upside podcast. So finally today, we're bringing you a clip from portfolio manager Peter Kahn, who focuses on high-yield bond investing. And he speaks about the opportunities presented by volatility. Enjoy.
Let's begin with data centers, what's funding them, lots of debt being demanded at this point. We just look to you for your moment in the markets here right now, because we've got you seated here, and you're a trader. You're trading this stuff. What's going on out there?
Well, it's a good time to be a trader because there's a lot of volatility in the markets at the moment. So there's also a lot of uncertainty about how many of these data center models are going to be required in 3, 5, or 10 years time. But the projections at the moment are just astronomical, as you well know, Pamela, about the degree of capital expenditure that's going to be required for the hyperscalers et al. To achieve their dreams. We're talking trillions of dollars over the course of the next few years. And, it's not so easy to find trillions of dollars in one place only. So sponsors and companies have been assiduously courting investors, for a few months now, but really
all kinds of investors
in style, in investment grade credit, asset-backed credit, high yield credit, private credit. All of these channels need to be, for lack of a better term, exploited. I mean, I kind of want to say used and abused by by those who are trying to achieve the build out. And we've seen a lot of activity in every corner of the market, particularly in the last couple of months.
Tell us about that. Like, there's a really big one out there that would it have caught you off guard even? I mean, this is what you do every day and have for your career, but it was a big bond sale.
For sure. What you're referring to is obviously the Beignet, hope I said that right.
Yeah, I did too, because I couldn't correct you. Yeah.
Finance deal that was, it's a JV from Meta and Blue Owl, which is a large private credit investor. And it was cheekily named because the data centers are based in Louisiana, so a reference to the famous Café du Monde down in New Orleans. And they certainly offered quite a sugar rush to investors because what came was a $27 billion investment grade deal, so one of the largest single tranche investment grade deals that we've seen in history, not just this year. And, very uncharacteristically, it went up 10 points. Right, that's not your garden variety performance for even a high yield bond or maybe even an equity IPO to register 10% on a day. That's maybe a little bit more mundane, but this sort of thing never happens in investment grade credit. So why did they leave so much value on the table for investors? Well, that's because 27 billion is a drop in the bucket relative to the financing needs.
Okay. And is there anything that you would point out to everyone that is slightly different in the structure? I mean, we're hearing a lot about the circular financing that's going on right now. There are lots of different pieces that are a little bit just slightly different financing that's going on. Anything to either worry about, note from your perspective? You look at this all day. Some people are saying, the hyperscalers want to go ahead and use their free cash flow for this and don't want to use debt, but they're finding kind of some other creative ways to make that happen. What would you point to that's interesting about the structure of some of these deals?
Yeah, that's a great question. And they do have a lot of cash that they've been accumulating over the last decade plus that they can decide to contribute to the overall investment need, but
rather than debt.
But clearly, again, scale is required here, so the cash alone won't do it. Secondly, clearly they wouldn't necessarily want to put all of their eggs literally in that one basket and continue to have flexibility to fund share repurchases, dividends, other needs, not to mention rainy day funds.
Sure.
And doing things with other people's money is what the financial market has learned, how to do, particularly if you need to do it in size over the course of the last 20 and 30 years, right? As long as there's adequate security and compensation, we're willing to, at least consider a number of those proposals. But, the kind of model that's coming in now to back some of the data center build-outs, it's not homogenous, right? So we've seen a few deals in the high yield market since the midsummer that have, come in either with a large hyperscaler backstop on a, kind of speculative shell that is building out the data center on their behalf. So,
a SPAC.
It's not necessarily like a SPAC, but more of a financial guarantor. Kind of like a bank of mom and dad sort of model. Sending this venture out to build something on their behalf that needs a lot of investment and a lot of time and critical parts in order to be constructed and created. But saying like, I'm there, don't worry, I'm the fallback.
Sure.
So that's, clearly as credit investors wanting, something firm to hold on to more so than a promise or a pledge of shares. That's going to have a greater attraction than deals that, are based on, let's say, flimsier guarantees.
Well, I hope you enjoyed today's show. Each clip you saw is from a full 30-minute video podcast available on YouTube, Spotify, Apple Podcasts, and more. Here at Fidelity, we're releasing new content daily, so please look up the Upside or FidelityConnects podcast for more. You can get an exclusive first look at Upside shows as a streamed webcast, where you can learn to be a better investor and hear from some of Canada's best stock pickers and leading financial experts. To not miss a show, head to fidelity.ca and sign up for the next webcast or the Upside newsletter. So, thank you for watching today, and I hope you'll join us again on the Upside. I'm Kyle Cheropita.